This video is for educational and informational purposes only and does not constitute financial, tax, or investment advice. Always consult a qualified professional before making any investment decisions. Past performance does not guarantee future results. Welcome back to Street Smart Finance. Today, we'll explore how just $100 and 3 low-cost ETFs can provide instant diversification and long-term growth. No need for stock picking. Let's get started. Why a mini ETF portfolio matters. When you start with limited capital, buying individual stocks can feel risky and time-consuming. A mini ETF portfolio solves both challenges. Broad diversification. Each ETF holds dozens or hundreds of companies, spreading risk across sectors and geographies. Low minimums. Most brokers let you buy fractional shares for as little as $1, so every dollar works. Cost efficiency. Expense ratios for core ETFs often range from 0.03% to 0.10%, dramatically lower than actively managed funds. By focusing on low-cost, broad market ETFs, you streamline decision-making and avoid the pitfalls of single-stock volatility. Even on $50 per slice, you can build a resilient foundation. Selecting your core 3 ETFs. Your goal is to capture the global equity and fixed income market in just 3 positions. We'll call this your core trio. 1. U.S. Total Market ETF. Tracks the entire U.S. equity market, large caps to small caps. Examples: Vanguard Total Stock Market, VTI, Schwab U.S. Broad Market, SCHB2. International Stock ETF. Provides exposure to developed and emerging markets outside the U.S. Examples: Vanguard Total International Stock, VXUS, iShares MSCI ACWI ex-US ETF, ACWX3, Aggregate Bond ETF, diversified basket of U.S. Treasuries, agencies, and investment-grade corporates. Examples: Vanguard Total Bond Market, BND, iShares Core U.S. Aggregate Bond, AGG. Allocating equally across these 3 can mimic a classic 60-40 portfolio on a micro scale. For instance, with $150, you'd buy $50 of each ETF. Over time, market moves will drift your weights, so we'll cover rebalancing shortly. Adding a tactical growth sleeve. As your mini portfolio grows, consider a small tactical sleeve, a 4th ETF for additional upside. Limit this to 5 to 10% of your total portfolio to manage risk. Small cap value ETF, e.g., Vanguard Small Cap Value, VBR. Small companies historically outperform in rebound phases. Real estate ETF, e.g., Vanguard Real Estate, VNQ. Income and inflation hedge through REIT dividends. Thematic/innovation ETF, e.g., ARKI Innovation, ARKK. High growth sectors like genomics and fintech, but with higher volatility. By capping your tactical sleeve at $20 to $30 on a $300 portfolio, you get growth potential without jeopardizing your core diversification. Automated contributions and rebalancing. To keep your mini portfolio on track, automate both contributions and occasional rebalancing. 1. Automate contributions. Schedule recurring purchases of $25 to $50 per ETF each month. Use your broker's recurring investment feature or set calendar reminders. 2. Periodic rebalancing. Every 6 to 12 months, check your weights. If any ETF drifts more than 5% from your target, sell the overweight slice and buy the underweight one. On a $500 balance, you might rebalance with just $25 trades. Low cost and efficient. Automation removes emotional decision-making and enforces discipline, so you're always buying low and trimming high. Monitoring costs and performance. Even small portfolios can get eaten alive by hidden fees. Keep an eye on 2 cost metrics. Expense ratio, the percentage of assets deducted annually. Target below 0.1% for core ETFs. Bid-ask spread, the difference between buying and selling prices. Shares with tighter spreads save you money on each trade. Track performance quarterly against broad market benchmarks, like the S&P 500 or a 60/40 blended index. If your core trio keeps pace, you're on the right path. If any sleeve underperforms dramatically for multiple quarters, reassess its place in your mini portfolio. common pitfalls, and how to avoid them. Even a simple ETF plan has its traps. Keep it lean and cost effective with these fixes. Over diversification. Too many ETFs dilute gains. Stick to your core trio plus one tactical sleeve. Fee creep. High expense funds eat returns. Always compare expense ratios and choose the lowest cost option. Bond neglect. No fixed income buffer means bigger losses and downturns. Hold 20 to 40% in your bond ETF. By limiting your lineup to a few low cost ETFs and including bonds, you stay focused on steady, long term growth. Transform $100 into a diversified mini portfolio, 3 core ETFs, plus an optional growth sleeve, automated buys, and yearly rebalances. Invest now, share your tickers below, and subscribe for next week's tax smart ETF strategies.